Good afternoon. Fantastic actually to see so many of you joining us for the annual launch of our survey on the financial performance of marketing services companies. This is our 31st year of carrying out this survey, and sadly again, as last year, we're running this as a webinar rather than seeing all you lovely people in the flesh, and who would have thought that when we did it virtually a year ago that would still be the case now. But it does feel like we made the right call in that regard, given the sort of current infection rates and the current advice going around. However, it certainly hasn't impacted the numbers, as we've had over 300 people sign up for this session, and quite a lot of those are logged on already. So I sincerely hope that it will be back to a physical event next year, and we'll be able to share a glass of wine with you all. The last 2 years of data collection have been particularly challenging. Companies' house filing extensions have meant that quite a few companies have not filed. However, we've still managed to pull together some very interesting data, supplemented by the anonymous data that we can get from our clients, as well as the survey that we sent out to all the people who signed up. So thank you very much for those who filled that out for us. That was really useful. A big thank you also to all the Moore Kingston Smith team who've been involved in putting the survey together and organising this afternoon's event. It really does take a few weeks of intensive data gathering and number crunching to make it all happen. So thank you very much. We all like a bit of good publicity. So those of you who want to tweet nice things to us about the event, the Twitter details should be on that holding slide, which you can see. So as well as presenting you with some industry data this afternoon, there'll also be a panel session where we will be exploring the extent to which good ESG practices can affect growth, profitability and enterprise value. The theme of our panel session last year was lessons from the leaders, and they were talking about their experiences of dealing with some of the challenges and pressures that the industry was facing during the pandemic. And we'll find out later whether the industry, or to what extent the industry did or not did manage to deal with all of those challenges. And one of the greatest pressures that a lot of my clients are finding at the moment is lack of available talent, and who would have sort of necessarily predicted that when the pandemic started. And I think we're yet to see the full effects of that and how that impacts wage inflation going forward within the industry. The industry is also still experimenting very much with the balance of home versus office working, with many agencies finding that the creative energy just isn't the same when people aren't all in the same room. So trying to find that balance that best suits what staff want and have sort of become a bit used to and expect, while still maintaining the quality of the creative output, definitely remains a challenge for many. One area that certainly has rebounded since last year is M&A activity. Whilst the usual suspects, the global networks, are not buying so much at the moment, our specialist media corporate finance division has not been short of deals this year, and there are plenty of other buyers out there, such as new foreign buyers, lots of smaller consolidators, as well as, and particularly as well as, the private equity houses. And all of these acquirers are really seeing the opportunities that lie ahead within the industry. So to take us through what performance in the industry has been of late, and also what the industry sentiment is in terms of what lies ahead, I would like to welcome Francesca Robe. Francesca is a media specialist director. Hi, Francesca. Francesca is a media specialist director at Moore Kingston Smith and looks after a portfolio of clients within the media, marketing services and film sectors. And most of her clients are owner managed businesses, ranging in size from startups right through to international groups. And as well as advising on routine areas of compliance, such as audit, tax and accounts, Francesca advises on specialist areas, including employee incentive schemes, valuations, and also works with clients on their strategy and value building. She's a member of the ICAEW Entertainment, Sport, Media and Advisory Group, and also co-edits the Moore Kingston Smith annual survey. So please do put any questions that you have for Francesca into the Q&A function, please in the Q&A rather than the chat, because it's much easier to keep track of it in the Q&A function. And then I will put those questions to her at the end of her session. So over to you, Francesca.
Great. Thanks very much, Esther. And thanks everyone for joining us today for what is our 31st edition of our annual survey. As Esther mentioned, we have had another challenging year producing this edition. Companies House have given another filing deadline extension to those companies that have requested it. And what that means is today we're launching our preliminary results. So these results are based on the results of the 140 or so companies that have already filed. And then once everybody else catches up and they file their results, we will release a full report, hopefully early next year. So as Ian did last year, this session is going to cover off the average results across all of the disciplines for 2020, along with some results from our latest online survey, so that we can really get a feel for how agencies are performing this year and also what expectations are looking forward to 2022. Before we start, just a couple of quick reminders. So all of the data that we use for our survey are taken from accounts filed with Companies House. Most of these accounts are audited, but even if they're not, all of the information we publish is publicly available information. Sometimes we do make adjustments to this filed data, but we try not to. We only make those adjustments if it means that the data is more comparable. So the most common adjustment that we would make is to ensure that staff costs is treated the same from agency to any agency, again, so that we can then compare like with like. So let's get started by having a look at revenue growth. Now, throughout this survey, when I'm talking about revenue, I mean gross profit, fee income, or gross income. Now, for the majority of agencies, the 2020 figures that are appearing on our chart now are for either their year ended December 20, and for a few agencies, it could be their year ends March 21. So it's no surprise really that a large proportion of those agencies saw their revenues decrease, as this was our year when the pandemic hit, and as you can see there, across the board, decreases in revenue. I think kind of going back to the start of the pandemic, most agencies initially saw kind of complete freeze on spending. Their clients were kind of pausing or cutting budgets, trying to work out how they were going to be impacted and how they were going to kind of make sense of everything moving forward. Once things had started to settle down, to some extent, it was luck as to how individual agencies fared. So, for example, those agencies with clients in the retail and live events sectors tended to be kind of worse affected, whereas those who had clients in, say, the technology and healthcare sectors, actually they saw their revenues come back more quickly, and actually some saw real opportunities and growth there as well. So just having a look at some of the results for the individual disciplines in a bit more detail. We've got direct marketing and sales promotion agencies being the worst impacted. They saw their revenues fall by nearly 15%. However, to be honest, over the past few years, that sector's really struggled, and we've barely seen kind of growth rates above a couple of percent. So it's not completely a surprise there. Media buyers, they also saw a significant decline, over 14%. We would probably expect that given just the decrease in demand last year for media. It was actually digital, the other significant decrease, which I think is more surprising. Their revenue fell by nearly 14%. Now, digital does tend to be a very project-focused sector, and so it could be that those projects just fell away very quickly. But actually, kind of digging down, lots of agencies did say that the type of work that they were doing for their clients changed, and that had an impact on their revenues. So we'll come on to how that's actually impacted their profit margins later. The other kind of subsector, PR, so they were the least impacted. And that is largely due to the fact that for PR agencies, they tend to have the largest proportion of retained fees. So once things had settled down, those revenues came back. So those are all of the averages for our individual disciplines. Next, we're going to have a look at our historic averages going back 30 years, looking at how this year's revenue decrease has compared. So we can see here the past 30 years individual results, and then we've got across the top an average for each of those 10-year periods. So we can see that the average growth rate has declined, but if we pick out some specific years for reference, so 2020, unfortunately, this is our 10% decrease in revenue. And going back to the other kind of low points we had, 2009, so that was the impact of the recession. And there back in 2002 to 2004, that was the impact of the dot-com crash. And actually, that was the only other year in 2003 where we saw revenue decrease. So when we look at the results for 2020, we really can see how significantly the sector is impacted. I'm sure you don't need me to tell you that. But what I think is interesting, and we'll come on to, is how quickly revenues recovered after these previous shocks or lows. So with that in mind, what do we think 2021 and 2022 will look like for the sector? Well, let's start by just analysing the results for 2020 first. So here on this slide, we've got a bar for every individual agency that we've included results for within the survey. And they are colour-coded according to their discipline, and each is plotting their revenue growth for the year. Then what we've done is we've ordered them. So on the left-hand side, we've got those that reported decreases in their revenue through to those that were lucky enough to report increases on the right-hand side. There were actually only 14 agencies that saw an increase from 2019. And just to kind of put that into context, when we look back to the results that were recorded for 2019, that in itself was also a challenging year. It was the year where the sector felt the impact of Brexit and the uncertainty around that. So unfortunately, a couple of difficult years for the sector. So next, what we've done is we have plotted these bars into groups, giving us something that we can compare our online results to. So as we can see there, the average decrease in revenue for 2020 was 10%. Now let's have a look what the responses from our online survey gave for expectations for 2021. So encouragingly, revenue growth of 13.63%. Obviously, when we look back at those averages, that is encouraging. But I suppose off the back of such a difficult year, what does this really mean? We also asked agencies to compare how they were expecting 2022 results to be compared with 2019. So our last kind of normal year, if you call it that. And encouragingly, the expectation is that growth on 2019 revenues for 2022 will be 16%. So maybe these are optimistic, but actually what you've got to consider is for this 2022 average, this is over a 3-year period. So it probably works out roughly in line with the average of margins over the past 10 years if we exclude the anomaly of 2020. So positive signs looking forward, but let's have a look at the story behind the results of 2020 in terms of the profits. So our next graph is plotting our revenue growth for every agency in our survey against the individual agencies' operating profit margins. And we've got, again, the different colours for all of the disciplines, and then a trend line there. Now, in most years, we talk about how key revenue growth is to achieving a reasonable operating profit margin, and that is still the case, but this year things were slightly different. So with such a decrease in revenues across the board, we would expect to see far more companies in the bottom left quarter on this graph. So we'd expect them to be reporting operating losses rather than profits with such a hit to their revenues. But actually instead, as you can see, there's far more agencies in the top left quarter. So despite these falls in revenue, they still managed to report profits. So let's have a look at this in more detail. Again, we've got the average operating profit margins here for each of the disciplines from last year's survey. And then we have the 2020 operating profit margins for those companies that have filed this year. Now, there are some interesting movements which we'll come on to, but largely, as we might expect, the sectors have reported reduced margins for 2020. But I think it's just really important to remember that this is off the back of a historic decline in revenues. So actually, these results are really not as bad as you might think. And with everything considered, they could have been a lot worse. If we just have a look at some of the specific subsectors, taking top 50 to start with. So the headline figures there do actually show that 2020 operating profit margins were an improvement on the 2019 results, which doesn't look quite right. But remember, not everybody has filed their accounts yet for 2020. So we've technically got an incomplete population. So to make things more comparable, we've also looked at the results of the same companies for 2020. And then again, if you look at the top 50, it shows that margins decreased from 10.7 to 10.1, which is in line with what we'd expect. Across the other subsectors, DMSP and PR, they both saw slight increases. Their margin held there or thereabouts. Again, it was digital's results that stood out as being unusual. And as we said, this was on the back of actually quite a significant decrease in revenues. So digging down and understanding what went on here, I think agencies were able to stop their use of freelancers quickly. Digital is the sector which tends to have the highest reliance on freelancers in normal times. So they were able to stop using those very quickly to protect their margin, but also the work that they were doing and the drive for digital during the pandemic has undoubtedly impacted them and actually led to them being able to kind of charge more, a premium for those services that they are delivering. So focusing more on the digital transformation and strategic offerings. We're just going to finish our kind of review on the headline margins by looking at the profits of the individual disciplines over the past 30 years in this graph. It shows us how the individual disciplines kind of compare to one another and how we've actually seen the trend of those margins kind of aligning over the period, but also just in terms of the average margin across the board and the trend of that decreasing. So what can we expect then from 2021 and 2022? Let's have a look. In the same way that we looked at revenue, we have also plotted this graph for operating profit margins to help us compare the results from our annual survey to our online survey. So again, we have a bar for each company that filed as part of our annual survey analysis. And as I'm clicking through, you can see that's all of the different subsectors. And then we've ordered that data. So we've got those agencies that made an operating loss on the left, and those agencies that made an operating profit on the right. Now, this, when we then put the data into our buckets to compare it to the online survey, gives us an average operating profit margin for 2020 of just over 10%. Now, this isn't a particularly high margin, but like we said, on the back of the decline in revenues, it's actually quite positive. So 2021, we had responses from agencies saying that they were expecting a margin of around 13%. And then for 2022, they were even more optimistic with an average of 15.2%. Now, it could be that there is some optimism in these results, and it's by no means a completely full population, but I think it gives us a really good sense of how agencies are feeling. And also it's a testament to how well placed the sector is to move forward after last year. I did actually go back and have a look at some of the responses we'd received last year when we'd asked agencies what they expected 2020 to look like. And the predictions were in the same ballpark. I think they predicted a margin of around 8%, and obviously we ended up slightly higher than that at 10%. So not a million miles off. Next, we're going to have a look at how staff costs and spend on staff costs relates to our operating profit margins. This first slide that we've got plots our operating profit margins against staff costs as a percentage of gross income for every agency within our survey. And if you've been to one of our events before, or you're one of our clients, you'll know that we set a benchmark target for agencies to try and keep their staff costs within 55 to 60% of gross profit in order to have a good chance of reporting a reasonable margin. Now, you can see that very clearly in this graph. If we look on the top right-hand side, there are very few agencies in this space. So very few agencies are able to report a decent operating profit margin if their staff cost spend is over this. So this graph is largely as we'd expect. It is slightly steeper, and that is because of a few things that we're going to come on to. So firstly, how has furlough impacted spend on staff costs and therefore operating profit margins for agencies in 2020? Now, for statutory purposes, the furlough income or furlough grants received weren't netted down with employment costs in agencies' accounts. Actually, they were separated out and shown in other income. Now, some agencies kind of gave the narrative on this, and others kind of lumped them in with other income that we had. So we couldn't take the data from all of the companies as part of the survey, but we did do our own research amongst our client base, and for those clients where we could look at the data to get an idea of what difference this would make to the results. So going back to our average spend on staff costs for each agency in 2020, that was 62.9%, up from 60.2% last year. But like we said, the difference being that this year, those agencies on average received 1.8% revenue in furlough grants. So what that does is that reduces the overall staff cost ratio down to 61.1%. When we look at the results for the survey, actually total employment costs decreased by around 3%. And we know that agencies were actually very proactive, especially at the start of the pandemic, reviewing their staff costs, so making redundancies where they needed to, putting in place pay cuts and restructuring plans. So this has definitely helped protect their position. And I think compared with other events, maybe on a kind of individual agency basis, so an agency kind of losing a key client or revenues not increasing in line with expectations, actually, because it was something that was affecting the whole industry, agencies were much quicker to respond, and that has definitely helped them preserve margin. As Esther touched on, interestingly, 94% of agencies that we did our online survey with expect to give pay rises in the next 6 months, and 72% expect to recruit. So there's definitely kind of the return of talent pressures, and it's really important that agencies keep this ratio in check to ensure that actually margins can recover. So whilst the furlough does go some way to explaining why margins held up despite such a decline in revenues, let us have a look at what impact freelancers and other costs have had. So usually when we're reporting on the data for freelancers, it's kind of another record-breaking year of increased spend on them. Unsurprisingly, that wasn't this case this year, but they did decrease by quite a considerable amount. So on average, and again, this is taken from our own data rather than the survey data because it's not publicly available information, but on average, agencies spent 3.7% of their revenue on freelancers. Now, this compares to more than 8% that was spent last year. So whilst freelancer resource does tend to be more expensive, it does offer the most flexibility. And I think for a lot of agencies during the pandemic, they put a complete ban on using freelancers, or at least increase the kind of controls over the ability to engage freelancers to try and help protect spend. So when we take the freelancers into account, along with the staff costs that we just looked at, adjusted for the furlough rebate, we end up with total employee costs of just over 64%, nearly 65%. Now, this is much higher than the benchmark target that we discussed of up to 60% for total people costs. And if we look back over the past few years, it is the main reason that as a sector, margins have been depressed, as the constant talent shortage and issues with the cost of talent have really kind of put pressure on margins. But at the same time, this ratio is less than we've seen previously, and so it's helped keep margins where they are. So we've had the kind of total spend on people costs, but we've also seen other incentives within agencies, such as rent rebates, less international travel and entertaining. All of those things have had an impact. I think a number of agencies were pretty fortunate that their rent or leases came up for review during the period, and they were maybe able to kind of hold off on committing to new spaces, again, making further savings. We can see in this survey that cost savings were kind of across the board. I think what will be really interesting is to see actually whether these things have to some extent changed for good. So will we see international travel go back to the levels it was before? Is it really as necessary as we all thought it was? Will hybrid working ultimately reduce premises costs? And could there end up being less pressure on talent given the success of remote working? And not at the moment. I think obviously Esther mentioned there's definitely a lot of demand for talent, and that's a challenge going forward. But all of these things, it will be really interesting to see how they impact results going forward. We often get asked whether directors' remuneration makes an impact to the results that we publish, and whether the fact that there are some agencies within the survey that are independent, and so the owner managers can choose how they take their remuneration, either as, say, dividend or salary, versus other agencies where they have put through salary for directors. Now, the short answer is no, it doesn't. We do carry out an exercise where we have a look at what would happen to margins if we substituted in a fair market rate for everyone. And because of the size of the population and the averages that we're looking at, actually the kind of overs and unders net down to have a really limited impact on those figures. It probably is worth making the point, though, that if as an agency you're comparing your results to our benchmark targets, you should be making sure that you're including a fair market rate for your director's remuneration and your salary costs. Otherwise, those KPIs aren't going to be comparable. So of all the agencies that have filed their results so far, these 10 on the screen now are those that recorded the highest operating profit margins. I think a couple of them at least are watching, so congratulations to them. And I think a special congratulations really, given that these results were achieved during a global pandemic. We can see there an exceptional gross income per head of over 270,000. That was somewhat helped by Lucin Holdings results. Profit margins of over 40%, and staff costs at 43%, so held within our target. A great set of results across the board and individually for all of these agencies. So we've had a look at how the top performers here have fared financially, but as you're rebuilding your agency, what else should you be thinking about in terms of driving value? What else are these agencies doing in order to be able to achieve these results? Well, along with producing this annual survey that we're discussing, we also work with agencies to support them on their growth journeys. And usually we start this assessment by working through 10 key drivers of value, which I'm just going to touch on now. So starting with clients, those top performing agencies have a high quality mix of loyal clients, and there are multiple touch points at those clients or brands. It's also really important that an agency isn't over reliant on any couple of individual clients, and so we suggest that actually no single client should account for more than 20% of your profit. Next, income. So having, as far as possible, a high proportion of current and forecast revenues which come from recurring, retained, or high probability income streams. Now, this can be more challenging if your agency work is project-based, but having repeat work with the same companies or clients, that can go some way to helping drive value through this area. The most valuable agencies stand out. They are different and they excel at what it is that they are doing. They have a clear, compelling and unique value proposition, and that is known to and valued by their target clients. The top performers also have effective, scalable and consistently applied BD processes, and having real structure to these processes as you're growing your agency is really important, because it ensures that new business efforts are targeted, effective and efficient. The most valuable agencies and those that are growing potentially for an exit as well, it's so important that they are not reliant on any of the owner managers. So they shouldn't be kind of critical to the day-to-day running of the business. And instead, there should be a highly capable, engaged, incentivized and committed management team, ideally who are kind of incentivized or locked in, as it were, for the next 3 to 5 years. So we've talked about and we've been through some of the key KPIs for the sector. One of the value drivers here is management information. So making sure that as an agency, you've got high quality data that allows the management team to proactively make decisions based on that data, and that it's, you know, timely information so that those decisions can be made at the right time. Having clear objectives that are underpinned by a compelling business strategy that is implementable. And these valuable agencies have got strong environmental, social and governance proposition, and that is communicated both externally to their clients and prospects and also internally with their staff. And then finally, just finishing here with profit. So we've looked at what the top performers achieved in terms of profit, but it's having consistent historical profit performance and also kind of realistic and robust profit projections. So those are our 10 key drivers of value. And if there's any of those that you'd like to discuss so that we can work with you to help your agency on its growth journey, then please do get in touch. A few final thoughts then before we finish with our Hall of Fame. So there's no doubt that 2020 was an exceptionally tough year for most agencies, with the most significant revenue decrease we've ever reported in the history of our annual survey. Despite this, though, agencies were quick to take action to make savings, including using the furlough scheme. And so this meant that overall the impact on margins was minimised. What this has meant is that actually the sector is in a really good place to take advantage of growth opportunities going forward, focusing on rebuilding better. Interestingly, 82% of agencies that we surveyed felt that ESG will be critical or very important to growing their agencies over the next 5 years. And this is something that the panel will be discussing shortly. But before this, who are our winners? Who made it into the Hall of Fame this year? Well, just a quick recap. To gain a place in our Hall of Fame, an agency's got to meet all of these criteria, which is, you know, particularly challenging given everything that we've gone through in terms of what agencies faced in 2020. So firstly, having revenue growth, that whittled us down to only 14 potential contenders. Then having fee income in excess of 120,000 per head, having staff costs of less than 55% of revenue, achieving an operating profit margin of more than 20%, having at least 3 months worth of overheads within net current assets on their balance sheet, and then obviously they need to have filed their accounts in order for us to review their results. So just quickly looking at who were the winners last year, and then our winners for 2020. So congratulations to all of those agencies, particularly impressive, like we said, given what a challenging year it's been. So that takes us to the end of our annual survey review. I hope you've enjoyed it, and I will hand back to Esther now for the panel discussion.
Thank you very much, Francesca. A very thorough review of the numbers. I did ask if anyone had any questions. We haven't had too many. I've answered a couple as we've gone along that have been very specific, but there are a couple of questions outstanding. So one of them was, you referred, Francesca, to the survey that we sent out for people to complete, which included the things like, you know, what people thought margins and growth was going to be for 2022. Somebody just asked how many agencies indeed completed that survey?
There were just over 100, so a slightly smaller population, but still a good number. And like I said, for a couple of the predictions that were made in our last online survey, I kind of went back and had a look, and it was a similar level last year. So I think it gives us a good idea.
Yeah, definitely a meaningful number. And the other question is, how much are profit margins being impacted or indeed looking better through the shortage of staff?
I suppose it depends on exactly what they mean by shortage of staff.
Yeah. I mean, I'm thinking that perhaps the impact of that's going to be seen a little bit more in 2021 and the numbers that we have yet to see, rather than the 2020 numbers, because I think for me it's been more this year that clients have been talking about that rather than last year.
Yeah, absolutely. I suppose also what will be interesting is where maybe the talent shortages meant that agencies are using more freelancers. Actually, we've got the new rules on freelancers that have come in April 21, whereby actually an agency has to consider whether or not those individuals go on their payroll rather than them being, you know, paid as a limited company. So it'll be interesting to see how that affects our averages next year.
Yeah, I mean, and also, you know, given that there is a shortage of staff, you know, inevitably that leads to wage inflation that I sort of alluded to in my introduction. So to a degree, any benefit from sort of not being able to recruit, well, benefit is sort of not really a benefit actually, because some clients have to actually turn work away because they haven't got enough staff. But any benefit there is probably going to be cancelled out a bit by wage inflation, I would have thought. But I mean, generally speaking, I mean, given that the sort of the high level of growth is predicted for next year, generally speaking, when there is a high level of growth in fee income, we do tend to see margins nudge upwards, because it tends to be that you recruit slightly behind the speed at which that new income is won. Oh, got another couple of questions have appeared. How is fee income per head calculated? Is it all staff or just billable staff?
So that is all staff. So we take your kind of revenue and then divide it by total staff numbers. So those that aren't revenue generating as well. Okay.
And another question, with relatively low profit margins, why do you think VCs or private equity houses are so interested in the sector? Well, I suppose part of that is the opportunity. I mean, maybe they think they're going to get them at a cheap price and there's lots of growth built in there. I suppose it's fair to say that they're not necessarily just interested across the whole marketing services spectrum. It tends to be where there's a sort of a data analytics, digital research focus. So it tends not to be the pure creative agencies. So those where private equity houses consider there is sort of scalability there. So there is maybe some IP there. There is value beyond just what they can create with people on the ground. So perhaps less impacted by the shortage of talent. Oh, lots more questions coming in. I don't know whether we asked this in the survey that we sent out, did we, Francesca? What's the average wage increase in 2022 expected to be? We asked whether people were going to give a pay rise, but I don't know if we asked how much, did we?
No, we didn't.
No.
Yeah.
We didn't. Apologies for that. We'll add that to the next survey. But I mean, for some agencies, I suppose that there might be a little bit of element of making up for the pay rises that they didn't give during 2020. but broadly speaking, a lot of clients I'm talking to are thinking of giving sort of, you know, inflationary pay rises. The key thing there is to make sure, of course, that you pass that pay rise on to your clients through your charge out rates. If a company's year end is March, what accounts do you use for the survey?
So for these 2020 results, we would include the year ended March 21.
Yeah. In the Hall of Fame chart, fee income presumably means gross revenue. Yeah, I mean, it's got lots of names, hasn't it, Francesca? People call it all sorts of things, but
yeah, the same thing.
Yeah, I mean, importantly, it's not turnover. It's turnover less third-party cost of sales, and people might call that fee income, gross profit, revenues. A lot of clients probably call it revenue, I would have thought. Gross profit per full-time equivalent target used to be 100. Your Hall of Fame is 120. Would you recommend as a guide for gross profit per full-time equivalent considering the pay rise pressure? Well, yeah, I mean, we've probably had it at 120 for a little while now as well. At some point that probably does need to go up as a target. We thought this year probably wasn't an appropriate year to increase it, but we probably will over the next couple of years. Do we know the balance of agency failures versus startups since March 2020? Well, I'd love to know the answer to that question. Unfortunately, I don't, and I don't suppose Francesca does either, but suffice to say, actually, I think I can hand on heart say I haven't had any clients go bust since the start of the pandemic that's been due to the pandemic. There were the odd one or two that were wobbling anyway, but that was nothing to do with the pandemic. But I think the failures actually have been fairly minimal. I don't know about your client base, Francesca.
I was going to say, I can say, yeah, exactly the same in my client base as well. And you know, there's those that have been, you know, pretty badly impacted due to their kind of specialisms, but no, none of those have gone down.
But that said, you know, periods of turbulence and change conversely do tend to lead to quite a lot of startups. So we are seeing a lot of startups in the industry. So hopefully that ratio of startups would be a lot higher than the business failures. Hurrah, that sounds great. Good. What percentage of gross product, I think we look at this specifically because this information isn't publicly available. What percentage of gross profit should agencies limit their spend on their own sales and marketing to? We have in the past done an internal survey on this, looking at the sort of the detailed P&L amongst our clients. I don't think we've done it recently though, have we, Francesca?
No, we focused on the kind of furlough and the freelancer aspects of that, but it, you know, is something that we could have a look at. Yeah,
from my dragging up my memory, I've got quite a small percentage in my head from what it used to be. It used to be around sort of 2, 3, 4%, I think, when we've looked at it in the past, but it might be one that's worth revisiting again. With inflationary rises of around 4%, NI rises of 1.25% from April and a more competitive talent market, is there a feeling that a 50 to 60% wage margin is going to be maintainable, or is that going to be difficult?
I think it is going to be a challenge, but at the same time, if we look at our kind of top performers, they have managed to kind of keep somewhat below our target. So it's definitely not an easy target, but I think it is doable.
In uncertain times and recessions, people tend to be reluctant to even consider changing jobs. It certainly seems to be the case now. Money seems to be secondary. Our clients looking at other ways to attract people. Well, I think they are, and I think they always have been, to be honest. I mean, having a good employer proposition is really important, and obviously that's made up of lots more than just the pay packet.
Yeah, absolutely. I think, you know, over the past 18 months, individuals have really kind of had time to think about what they want, who they want to work for, and what they want from their employer. So I think it's probably more important than ever. Yeah.
And last question as it stands is around B Corps. Actually, you mentioned ESG. How important do you see agencies becoming B Corp certified? Have you any information on how this has helped with business growth? I don't think there's enough of them that have been around long enough to know the impact it's had on growth. But Francesca, I think that's something that we could certainly look to maybe focus on in another survey, actually doing a bit of a deep dive on those that are certified as B Corp. Certainly a number of my clients, not that many, but a few have now become B Corps, and others are looking to convert. I imagine that's the same amongst your client base as well, Francesca.
Yeah, and it was actually a question that we asked in terms of our online survey, you know, what proportion of the agency had considered that or were thinking of considering it. And I think it was kind of more than 50% were going to kind of consider whether it would be worthwhile for them.
And that's quite a big percentage, isn't it?
Yeah.
I mean, it's not an unonerous process that you have to go through to be certified as B Corp, but I suppose the more that do it, the more we'll need to do it, because it'll become the norm to be B Corp certified rather than not. Okay, and last question as it now stands is, have you seen any softening of the freelance market in response to IR35?
I think it's difficult to give a response on that across the board. I think definitely some, but I think it depends on what kind of talent pool those freelancers are within.
Yeah, it's difficult, isn't it? Because of course it kicked in for different size agencies at different times. So I think we're yet to feel the full effect of that, but certainly quite a lot of clients are taking a sort of a zero risk approach to this and are just saying to people that actually we're not willing to risk HMRC coming and clawing all over our numbers and asking for extra tax. So actually you're just going to have to go on the payroll, and actually that will be interesting for our survey, won't it, Francesca, if that happens?
Yeah, interesting to see what that does to the employee cost ratio, and then also the spend on freelancers. I think there's going to be maybe the reduction that we saw this year will actually continue.
Right, we'll do this one last question, coming in thick and fast. With PR being the least affected in terms of revenue, in part due to the retainer model, do you have an initial view for 2021 in this space? I don't know how much we drilled down sector by sector in the survey that we did, Francesca.
No, to be fair, we didn't. We looked at that as a kind of total population rather than by discipline, so I don't have any kind of more data for that specifically.
I mean, my sense would be is that it will have been similarly resilient during 2021. It tends to be one of the more resilient sectors when there are crises, if you look back across the history of our surveys. So my sense is that will be similar situation for 2021 as well. Okay. Right, well, thank you very much, Francesca, and thank you everybody for asking questions as well. It meant that you're all paying attention and you're all still there, which is good to know. I mean, I think really, I hope everyone's feeling quite positive about what they've just heard. I mean, given the challenges over the last 18 months and the effect that it's had on revenues and fee income, I think we can safely conclude that the marcoms industry has sort of done itself proud, really, and on the whole has minimised quite a lot of the potential negative impact that could have been had on margins through their quick decisions, their restructuring and their refocusing. And I've no doubt that quite a lot of those decisions that have been made, some of which potentially were decisions that should have been made earlier, and what happened with the pandemic just sort of spurred agencies on to make some of those difficult decisions. Hopefully they will stand agencies in good stead for future performance, and certainly by the looks of it, with a quite punchy forecasts in growth and income for 2022, and even punchier margin predictions. I mean, if average profit margins across the whole industry end up being 15.2, then I think 2022 will be an extremely good year. Francesca also took us through some of the key value drivers that impact agencies, and of course one of those was ESG. And awareness of ESG has grown significantly in the last year, really sort of driven by the power of the consumer in today's market and a united demand from employees, clients and customers, and investors to be transparent about the true cost of business. And events such as the pandemic and a rise in natural disasters attributed to climate change have only highlighted the issue further, And the turbulent time over the last 18 months has certainly given agencies some time to reflect on their ESG values. And as you know, we had the question earlier, quite a few of them are considering moving over to B Corp status. So that brings me on to part 2 of the afternoon, our insight session, where we're going to be discussing to what extent good ESG practices can help drive growth and profitability and ultimately build shareholder value. There is certainly a growing expectation that companies should be addressing issues such as climate change and diversity and inclusion, and those that don't could face obstacles with consumers, with attracting talent, their supply chain, or seeking credit or investment. Therefore, it stands to reason, really, that whilst good ESG practice is a commitment to do more than just make a profit, it can also be a virtuous circle and help with profitability. Hence, this session is entitled Be Good for Goodness Sake. That's our attempt as accountants to be a bit creative with our titling. So I'm very pleased to welcome our guests this afternoon, Peter and Gonzalo. So Peter and Gonzalo, you would like to turn your cameras on and we can probably take the slides down now. We also had Chloe from Lucky Generals, Chloe Davis from Lucky Generals on our list of panelists. Unfortunately, Chloe can't be with us this afternoon. She did want me to share the reason actually why she can't be here, because it would have been easy just to have said that she was ill. But the reason is that she was actually racially abused on her way home from an event very recently, and so she felt unable to join us, and that's a real shame because I think she would have contributed a lot to the panel session. However, she did feel it was important that I shared the actual reason with you, because of course this is the only way that we can stamp out such abhorrent behaviour and call it out and make sure that it is erased. So thank you for joining us, Peter and Jose. So Peter Reid is CEO and co-founder of MSQ Partners. MSQ is a leading international digital and tech-enabled marketing communications group, and Peter is a regular contributor to media publications and sits on the UK government's main communications best practice council. He's passionate about sustainability and sponsored MSQ's initiative, which saw it become the first carbon negative UK-based marketing services group. And Gonzalo Bisquera is head of marketing and sales at GSK. Gonzalo leads the sourcing strategies for GSK's marketing, sales and technology services and looks after areas of spend, including media, market research, creative sales, promotions and IT tech services. And before joining GSK 7 years ago, Gonzalo held various sourcing roles at Procter & Gamble in Latin America. Gonzalo is a founding member of the sourcing board at the World Federation of Advertisers and part of GSK's partnership with Save the Children. So I have a number of questions that I'm going to ask our panelists, but again, it would be great to have some questions from the audience as well. So please do put additional questions into the Q&A function and I will try to weave those in as well. So I'm just going to start with a few questions for you, Gonzalo, then a few questions for you, Peter, and then we'll try and sort of muddle it up a bit. So hi, Gonzalo.
Hello.
How are you doing? Hi, thank you. I hope you found those numbers interesting, not as relevant to you as they will have been to Peter, but hopefully interesting nevertheless.
No, very, very relevant as well for me.
Yeah, you know what sort of margins all of your
well, I thought I knew.
Probably lower than you thought, actually, I bet.
but it's great to see the positive outlook of the industry. I mean, we're all cheering, of course, for the advertising and communication industry because everyone wins if we're all growing.
Yes, exactly. That's quite right. And if agencies are growing and agencies are profitable, they can attract better talent, and of course, then their creative output is better, which is obviously good for the likes of GSK. So, first question for you then, Gonzalo. So, how important really are ESG policies of suppliers to GSK, and how, I guess, do the Marcom suppliers to you compare to other suppliers, which of course are very different from some of the services that you procure from marketing agencies?
Thanks, Esther. First of all, thank you for having me. It's really a personal pleasure, and I'm an honor to be here amongst this peer group. It is very important, but I have to say it's becoming even more relevant and top of mind. ESG and sustainability strategies have always been part of our sourcing processes and our decision criteria, our decision tree for selecting a supplier. But it has become more relevant over the past year and a half. It's been, as you alluded to, a worldwide effect. But particularly with service providers, because I'm going to generalize a little bit more outside of Marcoms. IT service providers, professional service providers, consultants, and marketing agencies. It hasn't been an area of focus. So sustainability has been more evident in a packaging supplier or in a printing supplier or an airline. And I'm so glad that actually the ESG agenda has broadened beyond what we can actually see and touch, which is the packaging that we buy, to the services that we procure. Because most of the organizations out there, including GSK, are heavily outsourced. We outsource professional services to consultants, we outsource marketing agencies to the marketing industry. And we tend to forget that they're actually working on our behalf. So whatever they do on ESG actually is going to help us show up in front of our customers, clients, and patients as well. And that realization is now very evident, that whatever our suppliers do reflects on how we show up. So we can put a lot of effort on how we improve our ESG agenda, but if we don't ask our suppliers or partners to join us, then we're probably only touching a third. So it's like the iceberg analogy, where we're really only looking at the tip of the iceberg. But I would bet that over 2/3 of what we do, of the ESG impact, is actually with our partners, with our suppliers. So it is becoming much more relevant. I think it's a big realization in companies that we have to bring our suppliers on board, which is why supplier diversity and inclusion and ESG, the overall ESG agenda, is now becoming a much more relevant topic in decision processes when it comes to selecting an agency or the other. So it is very important. It's picking up, and particularly in services is where I'm seeing most of the focus, because we thought that having a recyclable tube is the only way where we can drive sustainability. But actually, when we used to fly, all of the agencies that we as a client indirectly asked to fly on our behalf, what's also causing a big negative carbon footprint. But also the type of people that the agencies employ on our behalf also generates a social impact where that agency operates, which is caused by us. And if we are not really incentivizing the move overall outside of our own doors, then we're shooting ourselves short. So that it is becoming a movement across, I think, my peer group, definitely. And I think I'm glad that I saw ESG on the 10 factor, the value factors that Francesca presented, because it is definitely very important.
Yeah, absolutely. I mean, when you're sort of considering the ESG credentials of your suppliers, do you do that in a structured way? Is there some kind of point scoring? Is there a list, or is it more of an unstructured feel for what they're doing?
Yeah, I think from a sustainability point of view, it's easier to get hard data on the sustainability commitment, i.e. non-PVC, net zero reductions by X date. When it comes to the social part of ESG and in a way G, there are organizations like MSD or in the UK, MSD UK, or WeBank, WBENC, that certify suppliers on their diversity agenda, and those are very strong organizations that we trust a lot on, and we ask for certifications to be considered. You are a diverse supplier, minority owned or diversity owned supplier. So those are a couple of the metrics that we looked at. Mm-hmm. But given it is I wouldn't say nascent space, but it's a space that is growing in importance and is so broad, we cannot only work with diverse suppliers as our only ESG strategy, because there is an opportunity to drive a positive ESG impact, even if you're not a minority-owned supplier, of course, right? We're talking to large corporations in this company. It is very important. I will ask everyone that when you are presenting to me and my peers and my colleagues, that you are very specific about what you're doing, because I don't think there is a specific qualification, a green marketing supplier, and because it's so wide. It can be that you're doing a lot of effort on actually social impact in the regions where you operate, or maybe you're looking at utilizing printing differently. Now we're not printing and we're not traveling as much, but it was something that would definitely we were tracking how much agencies were reducing their carbon footprint on reducing travel on our behalf. So please make it specific on what are your commitments for this account that you're pitching for, or if it is an account that you're already serving, bring it top of mind. It is definitely something that will go a long way with your procurement counterpart, because we're going to be measured as a company not only on our impact, as I said, but also on our suppliers' impact. And that's something that, J&J, P&G, I would say are leading, Unilever are leading the charge in reporting supplier ESG impact. And anyone that would like to, of course, join the I wouldn't say battle, but join the race for good, which we all should win, is going to have to want to have suppliers on their list that are helping them get there, because we are also going to report more the ESG impact of our supply base.
Like you say, it's difficult to quantify some of the E, S and G credentials, isn't it? But I suppose agencies that have become a B Corp, that is part way there to sort of trying to quantify and give you something very specific that they can say, well, we adhere to these different qualities, therefore, we are ticking certain ESG boxes.
Yeah.
You mentioned that creative diversity amongst your suppliers was pretty important as well when we were talking before. So tell me a little bit more about what you're trying to achieve there.
So it's two-front. I think diversity within the account or within the talent base that we use for our ads is something that I think has been going on for a while, and we've been championing a lot of efforts with the industry, with other companies, on making sure that we have the right representation in our ads, and we unstereotype some of the stereotypes that we have, gender or race, etc. So that's something that we will continue, but we're increasing the focus on is on the suppliers that you do business with on our behalf as well. So it's actually a very long chain of engagements, because you also, as an industry, you engage other parties. You engage directors for shooting the ads, you engage freelancers, you engage service providers, of course, so that you can operate as a business. So the diversity ask is across the whole supply chain. So we would like for our suppliers to make sure they're also working with minority and diverse suppliers. And those are the qualifications that I referred to earlier. MSD, WBA, and C will love to work with companies that have supplier diversity as also a top priority in your own corporations.
And has that made any sort of demonstrable difference over the years in terms of the number and mix of agencies that you're working with, or indeed the sort of the quality of the work that you're getting from those agencies?
Absolutely. I think diversity, as I said earlier, it is linked to, I think, and I'm a very big believer in, it is linked to creativity. I think when we talk about working with diverse suppliers, I think gets you closer to the realities of the world that you operate in, and I think the goodness really translates all the way to the account and ultimately to the work.
And you're part of the World Federation of Advertisers, which champions more effective and sustainable marketing communications. And tell us a bit about how the thinking is developing around ESG sort of more widely within the WFA.
Yes, I'm very lucky to be part of the, there's 10 of my peers, Heineken, P&G, Bayer, it was McDonald's, that we formed this coalition of sourcing community to start to change the perception of marketing procurement, because we have a very bad reputation that I think is changing. It has changed in some cases of being, the negotiators, the looking for profit improvement solely. And as a function, we're not actually. We're here to help our company drive growth, have better agencies, better partners, better people in our account. And in that effort of really changing the view of the function that I am a very proud member of, we talk a lot about the trends. And actually last week we had a WFA sourcing forum on how to influence business strategy, and ESG also was brought up as well. It is definitely a topic that as a function we have a leading role, because we manage the external relationships with with the industry, with you guys. So we are seen as a force to drive the positive momentum toward ESG. It is something that everyone is figuring out exactly how with marketing agencies. Diversity is, as I said, is already something that was in motion. The environmental impact in print and promo is very evident, and some print and promo materials, anything that is point of sales or activities on the shelf, is, I think, is also relatively mature, where everyone is making, you know, green shoots here and there, is on how do you drive better positive ESG through creative agencies, because it's mainly a, you know, people industry. So we focus on diversity in the account, diversity in the supplier, but also I've seen pitches where agencies, you know, commit to support particular charities or commit to do work in a community, you know, on the back of working on that account. So I think everyone is trying what is the best, what is the most influential, but quite honestly, what is the most impactful action to drive ESG mainly on the services area, like media and creative.
I mean, that's a worldwide organisation, isn't it, the WFA? So how does that message sort of from the advertisers to the agencies get disseminated down to the agencies? Is that through local trade bodies, or how do you how's the communication?
Yeah, so I think the WFA is a, as you said, globally recognized forum, and it's not actually the sourcing forum is the new bolt-on to it. It's got a very strong connection with CMOs and agencies who are also members of WFA. So there are regular events. Unfortunately, none of them face-to-face because of the obvious current situation, where we actually have been invited to industry forums recently, which we haven't been invited before. As I said, there was this, you know, stereotype of the function that sort of blocked that. So actually WFA is helping bridge the gap. We are being invited to talk to agency forums like the ones that the one that you're running today, and there is a very interesting reports published in the WFA about what the WFA sourcing stands for. And if anyone is interested, the WFA side has, you know, for the members available, a very interesting reports about procurement. What are we looking for in our agencies? What is really important in terms of selection processes? There's a very, very interesting report called Project Spring, which talks about that evolution of the marketing procurement function and what are the key trends when it comes to deciding who to work with.
Super, thank you very much. I'll let you rest for a bit and I'll ask Peter some questions, I think. So Peter, MSQ were apparently, and I'm assuming this is true, the first carbon negative UK-based marketing services group, which is a pretty good achievement. So tell us a bit about how you did that and why MSQ felt that was so important.
Sure, thanks. Maybe start with the why, and then kind of move on to the how. I think, you know, honestly, and you can be easily get into cliches here, it was because we thought it was the right thing to do. I don't know if everyone's aware, but kind of businesses are still driving 85% of the emissions around the world. And we had a few people originally who kind of really evangelized around the topic. And so that was the starting point. We were advising clients on sustainability, and, you know, we just felt we had to do something meaningful ourselves. And we really wanted to take a leadership position in the industry. So that was the sort of the core driver in a way. But you know, unashamedly, I would say it was also because we thought it had direct benefits for the business and for the group. You know, we can talk later about talent, but it absolutely did. But it also kind of had benefits from kind of opening up new opportunities, new revenue streams. But equally, we were quite, you know, very aware it could help from even a profile point of view. And actually, therefore, we really wanted to take this leadership position. And, you know, for me, that's absolutely fundamental. And that's kind of true if you're kind of Unilever, if you're us, or if you're kind of the Chinese government. You're only really going to drive change if it's beneficial. If you're kind of, otherwise, you're going to be pushing water uphill. So, you know, we accepted that as a position and really made a virtue of that kind of early on. And I think that was why we were actually able to achieve it probably, you know, much more easily than we thought we might. You know, it is true. We were, you know, certainly there were other agencies that done it, but in terms of groups and certainly kind of international groups, we were definitively the first. My message from the how, and really trying to, in some ways undermine some of it, is that it really isn't as hard as people think. And if there's one thing people take away from this, it's sort of the real challenge is getting a baseline and putting measurements in place and doing that across kind of all your kind of scope, particularly your scope 3, so your scope 1, scope 2, which are normally relatively straightforward. But particularly for professional services and agencies, kind of getting a handle of your scope 3 emissions. Once you've done that, again, the challenge for us was that it, in a way, it'd been even easier to do off 2020 because there was a natural drop in emissions across the group. But we made sure we measured 2019 as well, and we used 2019 as our baseline. And then really the key first step was then we have a partnership with Ecology that we put in place. Who are just kind of I think one of the better sort of offsetting organizations, but we then put in place an offsetting strategy with them, and then effectively invested in offsetting more than the emissions that we were creating, so hence becoming carbon negative, climate positive, whatever, however you want to sort of do it. But to put it into context, we're not a huge organization compared with Gonzalo, but we spent initially £100,000 in direct costs, and we kind of had 2 people fully dedicated to doing that, and we were able to achieve it, and we're actually able to achieve it in 3 months. Sometimes I think a lot of people are put off because they think this is just going to be impossible, and I needed to be educated myself in it, but it really isn't as hard to achieve as you think. What we're really now trying to do, because we could have a conversation, yes we don't, about the merits of offsetting and etc., but it's definitely not enough in its own right. So what we're now trying to do is to cut emissions per head by 50% over 3 years. And that is a much bolder initiative, a much more challenging initiative, and it needs you to actually reduce your emissions genuinely, which is obviously key. But also we've put in place, a number of smaller things like an electrical car leasing scheme. We've got a staff renewable energy scheme, which is a little bit of a challenge at the moment, but still the kind of right thing to do. We're moving into direct air capture, and we're hoping to buy our own wind farm in the next 12 months. To actually really start to kind of make a difference of genuinely reducing the amount of carbon in the environment. So as I say, the big thing I would share with everyone, particularly if you're smaller agencies out there, it's genuinely not as hard as you think it might be if you're starting out on this.
It's pretty impressive. I mean, and 100,000 isn't an insubstantial amount of money either, is it? I mean, it does show, demonstrate your commitment to making this work and making it work properly. And actually, I guess if you have spent that level of money on it, you're going to make damn sure that it does work as well.
And you're getting something in return as well.
Yeah. I mean, obviously, Gonzalo talked about, not just looking at what GSK does, but looking at what their suppliers does. Have you had to do that as well? I mean, obviously your biggest supplier in a way is your people, really, isn't it? And the behaviour of your people. But what sort of behaviour have you had to encourage to change within your people? And have you looked at your other suppliers as well?
We've so far focused more internally and with clients, because we think that's where there's a much bigger impact for us. We probably, to be honest, the sort of supply pieces is our next stage in what we're doing. And we do have production partners that are reasonable level of spend, but it's a pretty small portion of the overall picture. So we haven't sort of done as much. But what we're really trying to do, we've got a commitment for all clients that when we're embarking on a relationship or a campaign, we will dashboard out the impact of the campaign and work with them to put an offsetting strategy or a mitigation strategy in place for all of them. And we think we can do a lot more in that area, and that could make a huge difference. But we do need to look at sort of our supply chain as well, particularly if you move towards net zero. You can't do that without sort of looking at that. And we've tried to just do kind of lots of little things for people, as well as the sort of group commitments like military pledges. We've created a salary sacrifice scheme for staff so they can effectively offset their own footprint. As I say, the kind of the renewable energy we're doing in offices, but it's primarily aimed at people switching at home. And so, if you create lots of little things and try and even gamify it a little bit, I think it starts to make it a lot easier for people.
So, but it sounds like that's more sort of covering the sort of the environmental side of things. What about the S&G? They're a bit more difficult. Well, certainly more, like Gonzalo said, a bit more difficult to measure for sure.
Definitely, I think a lot of what Gonzalo said really resonated with me, in the sense that on the one hand, I think we've done a fair bit around particularly DE&I, which is our kind of, our main focus from a social point of view. We've tripled the number of apprenticeships we've done this year. We've put mandatory training in, unconscious bias, a lot of things a lot of people have done. But I personally kind of give us a best 7 out of 10 on DE&I, and I kind of give the industry about the same from an agency sort of point of view. So we're actually sort of stepping back at the moment, literally in the next couple of months, and thinking about where do we go from here. And for me, it's really about is really what Gonzalo was saying about creativity. It's actually about diversity of thought and about representing your communities and representing your target audiences if you're kind of supporting a client. And I think all too often, even in best intentions, because we want to measure it, it's slipped back to gender and ethnicity, which is absolutely part of the kind of issue and the opportunity, but it's not all of it. So we're actually trying to firstly reset our priorities and broaden our priorities, and to say really focus on genuinely having a kind of diverse team that comes up with better ideas and creates better creative ideas. And then we're now focusing more on setting baselines, so not even absolute targets, but just setting a baseline and trying to show that we've improved over 2 or 3 years. And then you've got that evidence, because it is really tough to measure, I think, from really delivering what, say, Gonzalo's organization wants, which is diversity of thought and better creativity. That's not just about kind of being able to say, well, we've got another sort of 10% representation in terms of different ethnic backgrounds, in my view. And I think interesting with a lot of the questions earlier and discussed, I mean, actually, I think we think the biggest thing we're now doing from a governance point of view is actually B Corp. We're quite well advanced in doing that, but there's now which might impact some of the questions earlier, there is a massive backlog in terms of the audit process now, so we're effectively waiting in the queue to do that. But I think your point, Esther, earlier, that it's actually genuinely a very rigorous assessment, and it measures all aspects of ESG. And so I do think from a kind of company assessing someone else, it's not a rubber stamp, and you've kind of gone through and you've proven you're delivering across the piece, and it's been quite micro measurements as well as sort of general stuff. So I think it's a really important thing to do overall. Again, I think it'll benefit us as a business in the medium term. I think more and more businesses will be looking for it. And I think it is a really good thing for people to take on. The other thing that I thought was interesting, and it's again in terms of some of the areas we might discuss later, is that I thought when we raised it, we might have a real issue with our private equity partner. So effectively, you're changing the articles and you're moving beyond shareholder value and social good and different stakeholders. Actually, they were incredibly supportive, and they sort of initially sort of jumped on it, and ended up us kind of introducing other members of the portfolio and explaining the merits and kind of what needed to get done.
Well, yeah, actually, I was going to ask, because it was your back by LDC, whether whether they are actively trying to influence your ESG policies, and whether sort of more generally, do you think investors are going to start to see this as important when they're looking at their portfolio of investments?
Yeah, I think they absolutely are. I think the truth is, certainly going back 12 months ago, that they've definitely always over-indexed on the G, and I think they really do try and understand the standards of governance in particular, and talking again about sort of if you've got an agency that's looking to come to market, I think that's probably still the most important thing to get right, as well as financials and etc. So it just gives you a level of confidence as an investor. But I think that they are now really waking up to the importance of both the kind of E and the S as well. Probably not in that order. I actually think that sort of diversity, people are recognizing, particularly in marketing, but across the board, is important. And I think absolutely for the first time starting to see that being audited at a DD stage in some cases and that kind of thing. And I think the environmental piece is, it's relevant in certain sectors and it can be critical, but I think it's going to become more critical. And I think the people are going to start to look at that as table stakes pretty quickly.
MSQ itself has been pretty acquisitive, hasn't it, over the last few years? Is ESG creds something that you look at when you're looking at your target acquisitions? And realistically, if something you had was great at performance, but the ESG creds were terrible, would that stop you from acquiring them?
I think what I'd say is at the moment not quite, but it's sort of moving in that direction. I mean, the way I would articulate it is that, you know, the most important thing is still generally, you know, the team, the financials, the motivations for having a conversation in the first place. But I think, you know, we would probably walk away and have walked away is if there's not the right, at least minimum level of governance. I think I always try and be quite understanding. If you're buying a small agency, it is very different from kind of, you know, operating at a large scale, but you still got to have the right kind of basic processes and instincts in place. Otherwise, it's not going to work in a larger group from that point of view. But I think the key change there is kind of diversity, and certainly, I wouldn't say we've walked away from too many, but it becomes a point of attraction for us. We're certainly looking at business in the US where it's a good agency, but there's a significant level of attraction in that it will materially move on our credentials in the US from a diversity point of view. So I think we are starting to look at that, and I think there will be acquisitions that are primarily led on that basis, certainly in the next 12 months.
Thank you. And Gonzalo, maybe ask you sort of a similar question. If there was sort of a Marcom supplier who was absolutely right for you creatively and the perfect fit, but their ESG creds were absolutely terrible, would that actually preclude you from working with them? Or again, how structured is the approach?
Yeah, well, I don't think we will probably consider them in the RFP. I mean, I think when we do an RFI, we want to make sure that it's people that we want to work with and we share the same principles and values about how important diversity is and how important, you know, our positive impact in the world is. Luckily, we haven't found that yet. I think we try to do a good job in terms of scouting first and understanding the principles and values and the strategy of the company before we even invite people to participate. I think probably
make it to the pitch process in the first place if the creds for that. Yeah,
exactly. I think now the tougher question is, so should there be a markup on the ESG, you know, as a supplier that an agency that, you know, has higher rates but it's got a stronger ESG agenda, you know, is something that our customers won't expect of us. So we are negotiating with Walmart or Walgreens, they expect that we have a strong ESG strategy, and they're not ready to pay more because we have increased our ESG commitments to the world. I think the same applies from us to the agency. So it is basically the minimum to be able to play in the game, that we have to share, you know, the values, principles and values, because ultimately it is a people business, and if we don't have share objectives, I don't think it's probably the right partnership, especially in this type of business where our growth is linked to your growth, or at least that's how we see it, right? So you create amazing ideas and campaigns that is going to help us grow. And if we don't have an alignment of what is really important for us, we probably shouldn't be working together. So I think the question on that scenario, should there be a markup? Definitely not, but I think it's probably going to preclude us from working together, and it would be a shame, I think, if there is that scenario where we have an amazing group of talent that you know, that we don't have you know, similar intentions in terms of our ESG. Now, that doesn't mean that if the agency doesn't have it but wants to build on it and wants to leverage on GSK to get there, then we'll be very happy to help, because I also recognize that particularly for smaller agencies, it is sometimes tougher to start. And we've been in situations where we connect them to the organization to get certified as a diverse supplier, or we share best practices that we have learned from working from, you know, the top 5, or is it the top 5 that you call them, and we can share and help them get on that journey. So even though they might not be there, but if they have the intent, we'll be very happy to support, especially smaller agencies that want to get on that train.
That's an interesting question, though, isn't it? I mean, if there is a cost to being ESG compliant or having very strong ESG creds, I mean, obviously you said, Peter, that, you know, it costs you initial investment in the first place. How is that cost shared, and is it ultimately passed on to the consumer, or does each business take a little slice of that cost along the way? I mean, Peter, to what extent do you think that having good ESG credit is actually helping you win work either now or in the future. So therefore, hopefully, ultimately isn't a cost to you. It becomes a benefit and helps drive growth and profitability.
Yeah, I think it's really interesting because actually just one point, I actually completely agree with Gonzalo, but it is interesting that certainly what we see and believe is actually consumers are willing to pay a premium for products, particularly that are compliant, particularly in obviously younger generations. And so arguably there is money in the value chain that's being created that kind of could be shared. I think, to be honest, the way, we think about it as table stakes, actually, that we need to be doing it is the truth. But it does and is opening more revenue opportunities. So, we're getting the return in that way. And I think it's doing that in a number of different ways, one of which is that you get specific, say, sustainability briefs that we've kind of, with our MSQ Sustain business, we're very well placed to handle. But also, this year, again, I think, almost even mainstream briefs now they're either built on sustainability or they have kind of a real sustainability component. I mean, just one example of probably 50 that, we picked up AXA Investment Management globally this year. I think 10 years ago, it's pretty unlikely the campaign would have been built around sustainability. It was absolutely kind of its core to the campaign, and the campaign we pitched is now running almost without any changes, and it's entirely built on the kind of not only sustainability, but actually an area of sustainability that they have a rightful claim to own. So it's also authentic.
And are you seeing specific ESG criteria appear in RFPs now? And if you are, sort of which of the E, S, and G tends to be the more prevalent?
Yeah, it probably reflects the other side of the coin of what Gonzalo was saying earlier, in that it's almost in every RFP, I would say, or actually RFI stage. Certainly, we will expect to be asked on our basic sort of almost numbers from a diversity point of view. That tends to be a percentage representation question, and I would say in the majority of RFPs, probably there's certainly a question of what we're doing from a sustainability point of view, and what we're doing from a diversity point of view. But I think if anything, more sustainability. If you take, for instance, even the main government framework, both in the UK and in Scotland, both of them, one of their sort of major 5 questions is around what are you doing in sustainability and diversity, which I think is not a bad barometer around that. I think, interestingly, that I think probably comes back to the measurement. Actually, don't really see much direct questions around governance. I haven't seen very much, but I think there's probably, it's where you get the more auditing type questions, in the, whether it's kind of audited with EcoVadis or, kind of someone like that, but it's not necessarily part of the responses. It may be part of the pitch process, or it might be part of your relationship as an ongoing supplier.
I mean, Gonzalo, you said that agencies wouldn't even sort of make it to the pitch process if they didn't have good ESG creds that are aligned with your values. What sort of specific criteria, and again, do you focus much on the G, or is it more on the E and the S that you'd be looking for?
Yeah, I think probably work in progress in the specifics requirements, because I think then we will probably restrict ourselves to the people we're going to work with, because there isn't a black and white list of ticking all of these boxes. Then you are, you're doing good. I think it's more, as Peter referred to in the RFIs, it's part of the questionnaire, and we'd like to hear of how are you addressing that question. Right. But what is more important of the three? I think that's it's a very tough question. I think because it's a service industry, we are all learning. I think as the S, is probably the one that is more palpable. I think the E is also now, as Peter said, is probably what he's been asked more questions about, the sustainability impacts, and D has probably also been more mature in the past in terms of obviously ABAC compliance and compliance with the work legal framework of the country you're operating with. Obviously, my question will be the three of them, but I think at the moment, maybe because of the current situation, I think the E and the S are the ones that are taking more prevalence.
Yeah, I think that's right. I mean, Peter, obviously, we alluded to it several times, a huge war for talent on at the moment within the creative in the marcoms industry. I mean, how important is good ESG practice in terms of attracting and retaining key talent?
I think it's absolutely huge, and I think you would certainly endorse the comments earlier that certainly we see that next year as by far our biggest challenge, and it's not a simple one in a inflationary environment and etc. But actually we see it as a real differentiator. I mean, certainly just people I've met and interviewed at different levels of the organisation, there's certainly been kind of 10 people who've highlighted sort of E element again on what we've been doing in sustainability, because that's probably been the bit that's most high profile and easy to see from the outside has been the key reason why they've joined us over other people. And I think definitely from a kind of internal employee engagement point of view, it's probably been the biggest and best thing we've done in the course of last 12 months. So I've probably got more direct data points on the attraction, and I've been genuinely quite surprised about how it's yes, you said earlier, kind of, if the money was way off, you may not get into the conversation, but it's been the thing that's made the difference. It's not been something that's just a nice to have getting you into the conversation. And I suspect it's the same from a retention point of view, but it's a little bit harder to kind of measure and to know.
And presumably for you, Gonzalo, diversity of talent within agencies is really important because it tends to reflect itself in the output, and your consumers presumably want to recognise themselves in the sort of the advertising creative output that GSK puts out there.
Yeah, and listen, we are in the business of buying service that is, as Francesca referred to, 68% people. So obviously, the better people you attract, the better agency you will be on our behalf. So I think it is a vicious cycle, as you alluded to earlier.
Yeah. Peter, would MSQ turn work away if potential clients didn't conform with ESG? But sort of the flip side of Gonzalo not working with agencies.
I think there are, if you thought you had a client who was a long way below acceptable, or it was below acceptable standards, I think we have and will do. But I think it's also fair to say that our main approach is to kind of engage and to influence much more than say there. We expect a minimum level of environmental commitment from you, otherwise we're not going to work from you. But I could see that kind of changing. But as I say, what we're really trying to do is actually sort of, even if it's a much bigger organization, kind of educate and work with them to put in place an offsetting strategy, help them understand what they might be able to do. And then sort of, potentially kind of, look to go beyond that. And part of the reason for that is that for the vast majority of organizations, and the sort of live example we've had recently, it's not a black and white situation, in that, we still work a little bit in kind of quote unquote oil and gas. And I think it's a really interesting, and it is a debate that we're having, around that. But actually, a lot of those companies are, on the one hand, arguably causing some of the problems. On the other hand, they're also kind of doing the most to drive a lot of the solutions. So I think it's quite hard to take an active role saying, we're only going to limit ourselves to work in these sectors and that type of thing. And actually, a lot of it is about working together. But I think, if there wasn't it wasn't a base level of governance within it, we wouldn't work with someone. If there wasn't the right attitude towards diversity and environment, we probably wouldn't, if our people decided they didn't want to work for that business. But I'd say it's a bit more in the margins rather than a real active consideration at the moment.
Yeah, it feels like it's a journey, isn't it? And it's about the direction of travel rather than anyone being able to get it perfect. Because as soon as you get it perfect, things will have moved on anyway. So you're never going to quite reach that end goal. That's almost going to be impossible.
But I do think across the board, it's. I think this year to me has been a real sort of step change in that this stuff has gone from being, yes, it's important, to being much more actively important. And so that's particularly true from an S, but it's also, and I think if we fast forward 2 years, I think a lot of things we've talked about will be doing. I think you will only be working with people who can prove things and measure things. That net zero commitments, even though they're a bit difficult to make, people don't really understand them at the moment. they're going to become critical, and that's a lot harder than kind of getting to sort of carbon negative.
I mean, when you're recruiting people, do they ask you specific questions about this?
Yes, 100%.
Yeah. We've had a couple of questions actually. Sort of a similar theme, really. Sort of, you know, small agency. One said small agency up to 20 employees. You know, what can we actually do to start to incorporate ESG from a sort of a practical point of view? And I know that list is endless, but maybe just a couple of practical things that they can start thinking about to get on that journey. Because I think for a lot of people, it feels like quite a big leap and a big barrier. They don't quite know what to do. So yeah, I mean, both of you, anything you can suggest?
There's one thing I can put in the chat afterwards, and it's not a massive advert for us. I think we make about £1 for every company that does this course, which we then put into our Million Tree pledge, such as. But kind of our chief sustainability officer runs a course specifically designed for small businesses with Beamer, the technology institution. And essentially, you can either do it for free or you can do it paid modules, and it's a really simple, easy way to educate small businesses as to how you can take the first steps from a sustainability point of view. And so, that's a pretty easy thing to do on that front.
Gonzalo, any top tips as to easy things that businesses can do?
Yeah, I think I mean, my advice for small agencies there is to get educated with with organizations like MSD or MSD or MSD UK or WeBank, because I think the power of the small agency will come from the collective, right? So there's a lot of peers that are trying to do the same, and they are you're gonna, I think, like Peter said, learning from the people who've been in a similar situation. I know it's hard to engage with large companies like ours. It is very hard for us. It's actually hard to know where are the small agencies that are actually a good fit for us. So the only thing I can advise in that situation is connect with your peers, which are your competitors, of course. But I think this is the right type of reason to connect in terms of if we all win in this. There's no one losing the business. Everyone's going to be better positioned to be better pitch against a larger agency. So other than that, I think I'm going to also help Peter here. I would love to see that link, Peter, if you put it in the chat, because I'd like to probably understand it myself. How can we help? And if there's anything that we and by we, seeing large corporations can do to help smaller agencies get there, I'm also open for advice.
Thank you both very much. Well, I think I will bring this to a close. I'm going to end on one final question to you both, really. Really, how do you feel, how important is ESG going to be going forward to the success, the financial and commercial success of businesses as we see it move up and up the boardroom agenda?
Go first, Gonzalo.
I mean, it is a defining part of our culture, and I think ESG is a very technical term. I mean, we are going with humanity as our core mission, delivering everyday healthcare with humanity, and because the word humanity encompasses a lot, it encompasses social, and definitely the E as well. It is. I think is going to be the reason why people join your company, the reason why our customers buy our products, and it's not going to be a differentiator anymore. And I think that'll be a good ambition. That is just table stakes, as you said, Peter. It's just everyone is doing it. So if you're not doing it, and I think human behavior, I learned, is more influenced by what you're losing versus what you're winning. So this is not about you winning more businesses. It's about you losing the opportunity, and the risk of losing does motivate people. So I think the future is, if we're not there, we're going to lose.
Yeah, I think that's right. Peter?
Yeah, I mean, I was going to say that I think it's certainly going to become in the top 1 or 2 considerations of kind of almost any company kind of out there. But also, I do agree it's going to rapidly become no longer a differentiator, which has got to be a good thing across every single element of it. I mean, there's an interesting sort of Accenture study that's done this year. It's pretty comprehensive around ESG, and there is an absolute direct correlation at the moment between actually performance against ESG and EBITDA performance across. So it's already driving kind of better business. So that will encourage more people to kind of get behind it. But I do think the broader societal pressures, as Gonzalo says, are probably the most important things here. And if you don't take all of them seriously, that consumers are ultimately going to vote for their feet, and that's going to come down and impact sort of potentially larger businesses first, but down to agencies at the end as well.
Well, thank you very much. Thank you both so much for sharing your thoughts with us and joining us this afternoon. It's been fascinating. And thank you to everyone in the audience for joining us as well. The session has been recorded, so as long as Peter and Gonzalo are happy for us to share that recording, just checking that I asked you both, then it will be available. So please do share that with your peers and colleagues who haven't been able to make it this afternoon. I think that's all there is to say. So thank you very much. I hope you all enjoy the rest of your day, what's left of it. And for anyone who I don't see beforehand, have a fantastic Christmas. Thank you very much. Thank you.
Thank you.
Bye.